Okay. So hi guys, a very good morning. Can you let me know if you can hear me and see a screen? Yes. Yeah. Good. So we're moving into the past papers of unit number 7. This is monetary policy. I would say the most important part of unit number 7. So that's why the class is from 8 to 11. If I can finish off the questions early, we will definitely finish off the class early, but I think it'll take a little bit more than 2 hours for us to get this done. So first we'll go through the MCQs in order. Once the MCQs are done, we will then move into the essay questions. So there is the extra class schedule, guys. I have sent the extra class schedule on the WhatsApp group. With today's class, we are done with unit number 7 because unit number 7, the next part, that is credit creation, we did it around 2 months ago. So I will try and make the recording available if it is not. So then unit 7 is done. So this Friday, we are doing unit number 8. So we have a class in the morning as well. Unit 8, there are 3 parts. I have sent all the tunes on the group. I will resend it. Unit 8, there are 3 parts. That is focus area 26, 27, and 28. So Friday morning, we will most likely be doing focus area 26. Friday night, we will be doing focus area 27 and 28. So there is a message on the group with all the extra classes, the times and all of it in detail, what and what we are doing, when and when. So please go through the message that was in the group. Right, so let's get started. Recording of the classes, guys, I will eventually upload it on YouTube, but I can't guarantee when I will upload. So it could even be 1 week before your exam, which might be too late for you. It's mentioned Thursday in the flyer. I didn't put a flyer though. I sent a WhatsApp message. Are the dates wrong? The WhatsApp message. It's correct, right? Sorry, WhatsApp message is Thursday. Then I will correct it. It's supposed to be. No, it says Friday, right? Unit 8, Public Economic. It says Unit 8, Public Economic, Focus Area 25, Friday, 26 September, 8 to 11 a.m. So have I put... So it's on Friday, right? Not on Thursday, in case if someone got confused. Okay, I will again send a reminder, don't worry. Let's get started with today's part. So today, we need to discuss this monetary policy part. It's a bit difficult, but remember we had this special seminar series where we talked about monetary policy. I hope most of you all were there. So those who had issues with monetary policy would have definitely been a part of it. We discussed. So let's get the past papers done. Okay. Right. So faster you all give me answers, the faster we can get things done. 2011, question number 33. Okay. When the central bank enters into a reverse repo agreement with commercial banks. Okay. First of all, what's a reverse repo agreement? In a reverse repurchase agreement, or we call it a reverse repo, does the central bank buy or does the central bank sell government securities? How many questions to be answered in part 2, guys? That's not a question you should be asking me with 2 months for the exam. You answer 5 questions. Okay. So a reverse repo is, Lamai, it's similar to what? It is similar to the standing lending facility. It's not the standing lending exactly, but it's similar to the standing lending facility. Now here, is the central bank selling or buying securities, Lamai, in a reverse repo? Sell or buy? What does the central bank do in a reverse repo? In a reverse repo, Lamai, central bank is buying government securities, not selling. In a repo, they sell. In a reverse repo, what happens is they buy government securities. So in a reverse repo, what happens? The CBSL, Lamai, they buy government securities with the promise of selling back later, with the promise that they will reverse this transaction later. That's why it's called reverse repurchase. Right? You purchase now, saying that, look here, I will reverse it later kind of a thing. So if the central bank buys government securities, think of an open market operation where central bank is buying. So if that happens, Lamai, tell me the story. Central bank is buying means who is selling? Commercial banks are selling. So then who is getting the money, Lamai? Do com banks get money or do com banks have to pay money? If central bank is buying government securities, central bank is buying, central bank is giving money and buying the securities. So commercial banks get money. So if commercial banks get money, now commercial banks have a lot of liquidity with them. What happens to their ability to give out loans now? There's a lot of money with them now. Ability to give out loans increases. And also, given that they have a lot of money with them, what will happen to the interest rates? Now they have a lot of money with them. Will interest rates increase or decrease? When there is very high levels of liquidity, interest rates will come down. When liquidity is high, interest rates will decrease. Then we'll go into the other stories. If ability to give loans increase, they will give out more and more loans. Now you all know the basics. More and more loans, what will happen? What will increase? The money supply will start increasing. If money supply starts increasing, then what can increase? Your aggregate demand can start going up. If your aggregate demand starts going up, what can you have? You can have demand pull inflation. Your price levels can start increasing. So that's the kind of story that happens in a reverse repurchase. Similar to a standing lending. Standing lending also what happens is the central bank gives money to commercial banks. Same story. Central bank gives money to commercial banks. Commercial banks have a lot of liquidity that can bring interest rates down. That can also mean that commercial banks will give more and more loans. More and more loans, increased money supply, aggregate demand, and price level. So we went through this very much in detail in our special seminar series that we had. So which one can be our answer, Ahmed? Answer number 1. Interest rates in the call money market will move upward. Where do you think interest rates will move, Lamai? Forget about call money market or anything. Overall, where will interest rates go? Interest rates will move downwards, right? That's what I told you earlier. Here, interest rates will decrease, I said, not increase. Because when there is so much of money in the economy, interest rates start coming down. So not the first one. Interest rates will move downwards, could be the answer. Number 3, money supply will be contracted. Will money supply be contracted? No, money supply is increasing, it's expanding. Wrong. Deposits held by commercial banks with the central bank will be reduced. That is the SRR part, Lamai, that won't really connect also. So I will keep that. Interest rates will not be affected. No, it will be affected. It will start coming down. So answer is number 2. 33 is number 2. Now remember, monetary policy, the questions aren't hard, but you should be able to logically understand the story. You can't memorize it and go and write MCQs for monetary policy. Logically knowing, when this happens, this will happen. When this happens, this will happen. So you need to know that. Call money Lama is that interbank call money market where you can call and borrow money. So when there is so much of liquidity, the interbank call money market and all, interest rates will be much lower. Okay. Then 2012. 2012 question number 30. A open market purchase of government securities. Same thing, right? Can you tell me again, once again? If the central bank does a open market operation and they purchase government securities, are commercial banks getting money or do commercial banks have to pay money? Commercial banks are getting money. So com banks are getting money. What is happening to commercial banks? Reserves, their liquidity reserves, can the amount of money they have, no? What happens? That means commercial banks reserves are increasing, their liquidity positions are increasing. Also, what can happen to interest rates then? If there is so much of money with commercial banks, we talked about it in the previous MCQ, interest rates can come down. Right? So as a result of this, what will happen now, Lamai? Now, commercial banks have a lot of money with them, a lot of liquidity. What can happen to the amount of loans that they give? The loans they give can start increasing. If the loans they give increases, what happens? Money supply increases, then you all know the story. Aggregate demand goes up, price level can go up. Okay, so with that in mind, now let's try to find out the answer. Okay, one by one, let's go. First, increases bank reserves. Yes, negative relationship between liquidity and commercial banks, but don't memorize it that way. Okay, increasing bank reserves. Yes, so bank reserves go up. Reserves means how much of money they have in their safe. Thus increases monetary base. Monetary base is my money supply. What do you think? It increases the bank's reserves and as a result ends up increasing the monetary base. Monetary base is what you call money supply. Looks okay, no? So this can be our answer. We look at the others also. Decrease bank reserves. No, it won't decrease. Wrong. Increase bank reserves. Okay, that part is correct. And decrease the monetary base. No, it is monetary base. We are looking at what? We are looking at these two variables, reserves and money supply. So it's not this. Decrease bank reserves, wrong. Decrease bank reserves, wrong. So answer then has to be number 1. No, you don't have minus marks in it. Okay. So 30 is number 1. Fine. Done. Then going into the next one. 2013 A-levels, question number 29. It is an interesting question. The question is saying, assume that the economy is at full employment. So economy is at full employment. Policymakers wish to maintain price level stable. So they don't want prices to change, but wants to encourage greater investment. What should they do with their monetary and fiscal policy? So let me try to show this to you now. If I am to draw this in a diagram, let's say this is your aggregate supply curve. This is your aggregate demand curve. So you're right now at equilibrium at full employment. So now what these people want is, like the government wants investments to increase, but they don't want the prices to increase. Now, investments, you all know, Lamai, is a component of aggregate demand. Aggregate demand is C plus I plus G plus N. So if investments increase, what will happen? If investments increase, my aggregate demand will increase. Then yes, investments will increase, but then the prices will also go up. Then that's a problem, right? If investments increase, aggregate demand goes up, prices also go up. So then that's not your answer. So you're looking for something. Do you realize that one of the policies have to be expansionary and one has to be contractionary? You'll agree with me there? Because if both policies are expansionary, then the prices will definitely go up. If both policies are contractionary, then investments are going to come down. So one has to be expansionary, one has to be contractionary. Right? It has to match. It has to kind of counter each other. Then which one has to be expansionary, which one has to be contractionary? Remember, your objective is you have to increase investments, but also keep prices stable. How do you do that? How do you increase investment, but also keep prices stable? So if right now, let's say price is this XX, it has to still be there. So what has to happen, Lamai? One policy has to be expansionary, one policy has to be contractionary. So if the government is the one, the policy makers, if they are the ones who want this to happen, they have to initiate, Lamai. So what the government has to do, they have to come and have a expansionary expansionary fiscal policy. So they have to, for example, let's say reduce their taxes, start long-term, let's say highway projects, and thereby they have to increase investment. They have to do that. But along with that, what can happen is you will then see prices going. For that, they will counter it by having a contractionary monetary policy. It won't work the other way around, Lavan. The other way around, you can argue, so why can't the monetary policy be the expansionary one and fiscal policy be the contractionary one? Now, when you have expansionary monetary, and if the government is coming and having a, expansionary fiscal, expansionary monetary, and a contractionary fiscal. So government is increasing taxes, they are coming and, reducing their spending, and they can't expect the private sector to go and invest then if the government itself is discouraging it from there. So it can't happen that way. What has to happen is government has to take the initiative. They have to take the initiative, and what should they do? They have to go and start, let's say, highway projects, do that, and thereby increase investment. But if you increase investment, what happens, Lamai? Aggregate demand will go up. So therefore, you have to counter it by having a contractionary monetary. You can't keep monetary as no change. Because if you keep monetary as no change, then price level will be high because you have to bring prices down. How do you bring prices down? Is mainly using your monetary policy. So you bring prices down. So that will be your answer for that. It's a very interesting question. Put a star and keep them things that you can think a little bit more. So which one is your answer then? 1, 2, 3, 4, 5. Number 5. So government starts, they have an expansionary fiscal. Along with that, to mitigate the inflation impact, they have a contractionary monetary. Aggregate supply is not connected to fiscal policy. Aggregate supply is there in supply side policies. Fiscal policy and monetary policy both are connected to aggregate demand. They're demand side policies. Okay. Done. Then 2013 has another one. This is an easy one. Expansionary fiscal policy can increasing government expenditure and reducing taxes. That's expansionary fiscal. Which of the following policy choices represent a combination of fiscal and monetary policies designed to bring the economy out of a recession? Now, first tell me now a good example of a recession was during COVID. So during COVID, we say Sri Lanka had a recession. Now, recession is a period where aggregate demand is low, firms are cutting down production, you have unemployment happening. So in a situation like this, as an economist, should you have a contractionary fiscal and monetary or an expansionary fiscal and monetary? What should you do? Now, economy is in a recession now. Do you contract the economy even more, or do you try to expand the economy? You have tried to expand the economy, right? So you need to have a what? During a recession, you need to have expansionary policies. So then can you all tell me, in terms of an expansionary monetary policy, what should we do? If we are having an expansionary monetary, should we increase the money supply or reduce the money supply? We have to increase money supply. What should we do with interest rates? Interest rates we have to bring down interest rates. So reduce the interest rates as much as possible, increase the money supply so that there is so much of money people will borrow and the economy will expand. Then in terms of fiscal policy, if you want to have an expansionary fiscal, what should you do? What should you do with government spending? Increase it or decrease it? If you want to expand the economy, you increase government spending, right? Government should now spend more, give more salaries, give more transfers, start capital projects, right? So increase government spending. What should you do with taxes, if you want to expand the economy? Expansionary fiscal. You have to decrease taxes. So look for an answer that talks about something like this. So you're in a recession, an answer that talks about an expansionary monetary and an expansionary fiscal. Number 3, increase government spending. Okay, that is this part. Decrease interest rates. Okay, that is this part. So you're having expansionary fiscal and expansionary monetary. Interest rates has a positive relationship with money demand. No, interest rates have a negative relationship with demand for money. Interest rates increase, demand for money will come down. Why is FI wrong? Engaging in a budget deficit, yes, that is good. That is expansionary fiscal, right? Engaging a budget deficit means you're increasing government spending, reducing taxes. But then selling government securities is not the thing. If you sell government securities in the open market, money supply will come down. Now, you saw in the previous ones where they purchase government securities. So if you purchase government securities, money supply went up. If you sell government securities, then money supply comes down. That's why the fifth one is okay. Discount rate is you can think of it as the return that you're getting on treasury bills and treasury bonds. It's like at your level, think of it like the interest rate. Okay. Done. 2013 done. Then 2014. Macroeconomic stability of an open economy is well reflected by what? Price level on the foreign exchange rate, price level and the employment rate, foreign exchange rate and employment, balance of payment and foreign exchange, inflation and unemployment. So when you talk about macroeconomic stability, which variables have to be stable? What are the most important ones? So when you talk about macroeconomic stability, you talk about internal and external stability. So how do you say that you have internal stability? What has to be stable now? What is the main target of the central bank also? It's to keep price level stable. So internal stability comes from keeping the price level stable. So if you keep prices stable, everything else falls into play. The interest rates, unemployment, economic growth, all of it will eventually end up becoming stable. How do you have external stability level? External stability. What has to be stable for you to have external stability? Your interest rate. Sorry, interest rate. Your exchange rate has to be stable. So which answer talks about these two? Your price level and your exchange rate. Answer number 1. Okay. So price level and your exchange rate has to be stable. Discount rates, yes, we'll complete. I think there will be some questions in the future. We'll complete. Okay. Right. 2014-30, answer number 1. Then 2014 question 31. They're saying the macroeconomic objective. BOP will align with the exchange rate. So when your exchange rate is stable, your BOP will also kind of become stable. Okay. A macroeconomic objective to achieve by reducing the rate of interest. What are you trying to achieve, Lama? By reducing interest rates, what are you trying to achieve? You're trying to increase the what? You're trying to increase money supply. Okay. By increasing money supply, you're trying to increase the aggregate demand. What components of aggregate demand? Can you be more specific? Aggregate demand is C plus I plus G plus NX. Which ones are you trying to increase? You're trying to increase consumption. Okay. But more than consumption, what are you trying to increase? When you reduce interest rates, yes, people will, you take loans and build houses. People will use their credit cards. Yes. But what is more interest dependent? Investment. So if you reduce interest rate, firms will start investing now. They will expand. They will buy factories. They will buy machines. So it's your investment that you're trying to increase by increasing aggregate demand. And thereby, what are you trying to do, Laman? Yes, there can be a bit of an increase in price level, but that is okay. But what will happen to economic growth? If aggregate demand increases, people are consuming, there's a lot of investment. So you're trying to mainly promote economic growth. So then can you see economic? See if there's an answer that talks about something like this. They're asking you what is the objective. Okay, let's see. Decrease in consumption. No, objective is not to decrease consumption. Increase in production. Okay. Due to an increase in investment and aggregate demand. Makes sense. So you increase production. There is increase in investment. Aggregate demand goes up. Production improves. Overall, you will have economic growth. That looks like an answer. Increase in profits of firms due to increase in consumption. Is that your objective, Lamai? Is the objective of reducing interest rates to increase the profit of the firm? I agree, increase in consumption investment part. The latter part of it is correct. But are you reducing interest rates with the objective to increase profits of firms? There is nothing like that. Guys, today, sorry, I couldn't tell you. So the central bank monetary policy review meeting, nice meeting to talk about also. So central bank's monetary policy review meeting happened today, early in the morning. The decision relating to the policy rate was out. What do you think? The overnight policy rate is at 7.75%. Did they reduce it? Did they keep it unchanged? Did they increase? What do you think they did? So usually they have around 6 monetary policy review meetings. One of it happened early morning today. They kept it. They kept it unchanged. Right? So they kept it unchanged at 7.75%. Because even though inflation is down, they're still being a little bit cautious because the central bank knows what happened earlier when they reduced interest rates too much, how that led to huge levels of inflation. So they're being very cautious with reducing interest rates. So they didn't reduce interest rates yet. The Fed cut interest rates. US Federal Reserve last week, they finally cut interest rates for the first time in 2025 after Trump wanted so much of cuts. Finally, the Federal Reserve chair had to give in and he cut rates on his end, but we didn't cut yet. Personally, I feel there will be at least one rate cut in the upcoming year because there's only one more meeting that is left. There is a meeting that will happen in November, end of November. By that time, you're done with your econ paper. I feel they can bring it another 25 basis points down from around 7.75. They can bring the overnight policy rate to around a 7 if inflation is under control in these next 2-3 months. So in these next 2-3 months also, if inflation is at around that 1-2%, there could be a rate cut in November. But this one, I also felt that they will not cut, and they did. So let's see how it goes. Nice. Right. So if they cut rates, it's not the third one. Fourth one, increase in government tax revenue. You're not trying to increase government tax revenue by cutting interest rates. Now, taxes are fiscal policy. So not this. Emergence of new investments due to an increase in share prices and business profits. We don't talk about that, right? We are not talking about you're not cutting down interest rates so that share prices can go up and business profit can go up. Now. So then not this as well. Your answer would be number 2. You're reducing interest rates so that the firms will now invest. They will, when I say investment, they will start new factories, they will start new production, they will open new branches, buy new machines that will improve production and overall aggregate demand as well. So increase in production level comes in between this. So when aggregate demand increases, production increases. And as a result, the economy will grow. That is what happens. Okay. So answer 31, 2014-31 is number 2. Then the next one, 2014-32. This is easy, Laman. Examples of expansionary monetary and fiscal policies. Basic question, no? So we'll go one by one. Increasing SRR. Is that expansionary monetary? Increasing SRR is contractionary monetary. No. So I'll cut off there without even reading. Selling government securities, is that expansionary monetary? Will you expand money supply, expand the economy? If you sell government securities, no. If you purchase government securities, we did that before, right? So no. Increasing the SRR, again wrong. Purchasing government securities, is that expansionary monetary? If central bank purchases means they are giving money to commercial banks. Now commercial banks have a lot of reserves. Yes. So this is what we talked about. When the central bank purchases government securities, it expands the economy, right? That part is correct. So when we look at the second part of them, then central bank purchasing government securities and reducing taxes, is that expansionary fiscal? Yes, no. So this part is expansionary monetary. This part is expansionary fiscal. Is in line with our question. The last one, increasing interest rate. Is that expansionary monetary? If you increase interest rates, your increasing interest rates can remember that is contractionary monetary. So then is also wrong. Those are not difficult ones, Lama. These questions are pretty easy as long as you know the basics. If you're struggling with something like this, then there is the problem with you not knowing the basics out. Okay. Now, then 2015. Now, one more thing I want to remind, I shared a small video yesterday as well. There is the MCQ program coming up in October. Now, this is September. I will most likely open registrations in probably, today is Wednesday, no? By around tomorrow, or maybe most likely by around Friday. So the MCQ program is the last 30-day kind of a program that I do. The MCQ books, so it's put to print. I have 2 copies from the last year's what I printed. So those are 2 books. Both books have 500 MCQs each. There is a grade 12 book and a grade 13 book. 500, 500. Total, there are 1,000 MCQs. The objective of this is, with the 1,000 MCQs, to cover the entire syllabus. So the questions are not past paper questions, because past papers I'm doing with you. That's why I'm trying to put some extra classes and finish off the past paper class soon, so that we can focus fully on that MCQ program. So that is there. 2 objectives of the MCQ program. One is to overall increase your MCQ tackling thing. The target is with this to learn how to get MCQs done, and out of the 50 to at least so that you get around 45 of the MCQs right. That is one objective. The other objective is I have made the questions in a way that covers the entire A-level syllabus. So even the small, because 1,000 MCQs is a lot of MCQs now. Even to cover those small areas, to cover that entire thing is how I have made the thing. So then if you do this as in the last month, it will act as a way of revising the entire syllabus, and also it will act in a way to level up your MCQ thing. So that's what we have in October. In October, there is no mock exam series. Mock exam series will be done. Some of it will go to October, but there is no mock exam fees that you have to pay. That will not go on that. There is, the one I printed in 2023 is still relevant. There are small things that I changed. If you have that book, that is fine. Okay. So we will get that done. The registrations are not open yet. I will open it most likely by tomorrow or day after. There will be limited slots left because I'm only printing a limited amount of books. So that will be allocated on first come, first serve basis. You can pass the message to any friend. The answers of the books are, MCQs are also there, Lamai. So the answers are also there. So you can do it alone. You can mark it by yourself as well. The difficult questions, I won't discuss all 1,000, Lamai, because that I feel will be a waste of time. There are some good, tricky MCQs. Those ones I will discuss, but if you all have doubts on the other ones, definitely, you can definitely come and clarify as well. No problem at all. So the fee for it, I haven't finalized, but it will most likely be around 3,400. So the entire program for the 1,000 MCQs will be around 3,400. So you will get the 2 MCQ books. It has the answers also. It is divided lesson wise. So the MCQs go from lesson wise. Now unit number 1 will have, let's say, around 80, 90 MCQs. Then unit 2, then unit 3, then unit 4. All the way it will go until that is how the book is divided. The answers are also there. Right. I will discuss the difficult MCQs. If you all have doubts on different stuff, you can come and clarify as well. If you've already purchased it before, some of you would have purchased in 2023, right? I'll give you all also a bit of a solution on what you can do. If you are there in the official registration form where you have purchased, maybe only for the discussions, we can look at a fee. Okay, right. Just keeping you all informed, because usually what happens is, once all the slots are filled, people start texting me. Same thing happened with the special seminar series. Same thing happened with the mock exam. Because once slots are filled, I don't take because it's very hard. Because I'm opening registrations early also. So because this book has to be couriered to you. Still, I also haven't got it from the printers yet. It's put to print. Most likely by this Saturday, Sunday, I will get the printed books. I will open registrations by, let's say, tomorrow. So if you all have paid by, let's say, this thing, then the first set of tutes itself, you all will get. The tutes will go, but very late, that becomes a problem. Then others you can't do. So target is at least to do around, let's say, in the last 30 days, if you can do around 30 MCQs a day. So 30 MCQs can around 1 hour each day. 1 hour each day, you can finish off this 1,000. That is the target. Okay. While you can do anything else that you are doing in general, but also allocate around 1 hour a day to get the MCQs done. So then 30, 30, 30, 30, you will finish the 1,000 MCQs in 33 days. Okay, right. Final seminar will happen end of October. That I haven't opened registrations or anything. I will let you know. Okay, so back to this. 2015 question 36. Which of the following would be expected to occur as a result of an open market sale of government securities by the central bank? Same thing as before. Earlier, they asked open market purchase of government securities. Now they're saying open market sale. So you all tell me the story again. Now, if the central bank does an open market operation, and if they sell government securities, now central bank is coming and selling government securities, and commercial banks have to buy. What happens to the amount of money? Now, commercial banks, do they have to pay money or will they get money? Home banks, if central bank is selling, central bank is saying, look, yeah, I am selling, you have to buy. That means commercial banks have to pay money and buy. So com banks pay money. So if commercial banks pay money, can you all tell me the story about what happens to the amount of reserves the commercial banks have? Reserves can actual money they have in their safe now will come down. In other words, the liquidity is coming down or going up. Liquidity means how much money they have. Liquidity is decreasing. What can happen to interest rates then? If now commercial banks don't have much money, central bank has taken most of it, now interest rates can increase, right? So along with this then, what will happen to the amount of loans commercial banks give now? Now commercial banks don't have much money, interest rates is a little bit higher. What happens to loans? Loans will start coming down. If loans start coming down, what can happen to money supply? Money supply comes down. Money supply comes down under aggregate demand comes down. Aggregate demand comes down under price level starts coming down. Okay, so that's the story. Logically, if you know the story, now see which one is your answer. One by one. Increase real GDP. What do you think, Clara? If the aggregate demand comes down, do you think GDP will increase? If there is lower aggregate demand, aggregate demand comes down, your GDP will also come down. So not one. Increase in the interest rates charged on loans. Is that there somewhere in our flow chart? It is there right here. Increase in interest rates. So that can be our answer there. Increase in number of loans made. Is the number of loans increasing? No, number of loans are coming down. Wrong. Increase in private investment. If aggregate demand is coming down, will investment increase? Investment is a component of aggregate demand. Interest rates are high, now will investment increase? No, investment will come down. Wrong. Increase in money supply. Is money supply going up in our flow chart? No, money supply is coming down in the flow chart. So then you stick to answer number 2. So again, I'm telling you all, these are not difficult questions. But these are logically how it works is what you need to know. If you have my special seminar recordings, please go back to that. Or if you have any of my theory class recordings, go back to that. Or let's say you don't have any of it, you studied it somewhere. So go back to those notes, understand the logic behind why this is happening. Then these questions are very easy. At one point, this will even become 3 marks kind of questions as long as you know how it works. Okay, next one. 2017 question 29. They're saying an inflationary gap could be reduced by. Now, what is an inflationary gap? An inflationary gap is where the aggregate expenditure, it is more than the aggregate output. So you ideally want to bring aggregate expenditure down, or you want to contract the economy. You want to think of something where you have to bring aggregate expenditure, aggregate demand down. So if you want to bring aggregate demand down, now there is inflation. So you want to bring aggregate demand down. Should you have contractionary or expansionary policies? If you want to bring aggregate demand down, you need to have, to reduce inflation, you need to have like contractionary policies. So tell me, so you're looking for a contractionary fiscal policy or a contractionary monetary policy, any of the two. So we'll go one by one and look at the answers. Answer number 1, increase in government spending. Is I want you all to tell me whether it is expansionary or contractionary, whether it is fiscal or monetary policy. One by one, let's go through. Increase in government spending. Tell me, what does it belong to? It is expansionary. Expansionary what? Expansionary fiscal. So not this. We are looking for a contraction. Increase in money supply. Expansionary monetary. So then not that. Increase in income tax. Contractionary fiscal. Could be our answer there. Right? We are looking for something that will contract. Now we'll see. Yeah. Contractionary fiscal. Decrease in central bank discount rate. Discount rate, you think of it as interest rate level. Interest rate on treasury bills and treasury bonds. If you decrease, what happens? If you decrease interest rates level, decrease can expansion, right? From a decreasing interest rates is expansionary monetary policy. Then a decrease in the SRR, that is also expansionary monetary policy. So which one is your answer then? Which one is the contraction policy? Which one can reduce aggregate demand and reduce that inflation impact? Is this answer number 3. Tax increase, government revenue. Tax increases government revenue, but when you say contraction, we are not talking about government revenue contracting. When you say taxes increase, it contracts aggregate demand. That's what it's saying, contraction. When taxes increase, consumption will come down. So aggregate demand comes down. Fourth one, it's like this, right? Now, in simple terms, discount rate, you don't have to go into very much in detail. But if I'm just simply explain what is a discount rate. A discount rate, you can think of it as the return on government securities. So I'll tell you where this word discount comes from. Now, let's say, for example, a treasury bill. Now, let's say a treasury bill, which is 100 rupees. A treasury bill has a face value of 100 rupees. This is a treasury bill's face value. So how treasury bills get traded in the market is now let's say government is issuing a 100 rupee treasury bill. So people can buy it not at 100. Let's say people will buy it right? You will purchase this at a discount. You will purchase this at, let's say, 95 rupees. You will purchase it at 95. If you hold it for 1 year, then you will get that 5 rupee profit. That's how my treasury bills work. Now, every week, Sri Lankan government, the central bank, on behalf of the government, they have a treasury bill auction. So in this treasury bill auction, they sell treasury bills. Let's say they are selling a 100 rupee treasury bill, but it is sold at a discount. So you have to pay, let's say, 95 rupees only and buy a 100 rupee treasury bill. So then at the end of 1 year, you will get a 5 rupee kind of a profit. So the amount of profit you get is what you call your discount rate. So how you calculate it is, so you're getting for this, you're getting a 5 rupee profit for an investment of 95 rupees. So you're investing 95 rupees. For that, you're getting a 5 rupee profit. So as a percentage, how much is that? That's what you call your yield or your discount rate. How much are you getting? 5 over 95 into 100. It will be a little bit more than 5%. 5.26. So that's what you call the discount rate. 5.26%. At your level, it's in detail. This is the return you're getting on treasury bills and bonds. Now, I'll show you how this affects money supply. Now, think, if you can, now let's say your discount rate is very high. Let's say 100 rupee treasury bill. Let's say, you can buy it at 75 rupees. Let's say you can buy at 75 rupees. How much is the profit that you will make? If you buy it at 75, at the end of the year, you can give it at 100. You're making a profit of 25. For an investment of how much? How much are you investing? You're investing 75%. So as a percentage, how much of a return are you making? By investing 75 rupees, you're getting a 25 rupee profit. You're making a profit of percentage 33.3%. You're making a 33.3% profit. So that is a very high discount rate, no? So when your discount rate is very high, now think and tell me, commercial banks, with the money they have, will they give it out as loans to the public, or will they use that money and buy treasury bills and bonds? What do you think? Think you're the bank manager. You're the bank manager. You have got some money as customer deposits. Are you going to give loans to the people, or are you going to buy a treasury bill that is giving you a 33% discount rate? Discount rate is like the return you're getting. 33% discount rate, everyone will do that, right? That is what happened in Sri Lanka in 2022, 2023. These discount rates were crazy high. So no one was giving loans to the private sector. All the money was going to the treasury bill, treasury bond market. So then, logically, if your discount rate increases, I'll just say DR, what does that mean? Commercial banks are going to put money there in the treasury bill, treasury bond market. They're going to buy treasury bills and bonds. So the amount of loans they are giving to the public will increase or decrease. Loans to, let's say, the private sector, the public, normal people, that will decrease. So then as a result, what will happen? You all know the story. What will happen to money supply? Money supply will come down. Aggregate demand will come down. Price level will come down. So that is also like contractionary monetary. You're reducing money supply by increasing the discount rate. So commercial banks end up putting their money there. That's the discount rate story. At your level, in detail, knowing this is not that much needed. Don't worry. Since someone asked, I just explain. Okay. Then 2017, there's another one. 33. Which of the following happens when the... Why is it expansion? I want to understand that. I haven't written expansion. So when you increase the discount rate, I am saying contraction remark. Here they are saying decrease in the discount rate. So if the discount rate, okay, think of the discount rate comes down. So decrease in the discount rate means expansion monetary. Yes, I agree. That's what the question is saying. What I explained is the opposite. I explained the increase in discount rate. Okay, think Lama, if the discount rate was very low, let's say for example, to buy a 100 rupee bond, treasury bill, you had to, let's say, pay 98 rupees. How much is the profit that you're getting? You're getting a profit of, today you pay 98 rupees and buy the treasury bill. 1 year later, you can sell it off at 100. So you're getting a profit of only 2 rupees. You're getting a profit of 2 rupees for an investment of 98. So as a percentage, how much of a profit are you getting? You're getting a profit of only 2.04%. So if that is the case, Lama, if the discount rate is very low, will commercial banks want to buy treasury bills? They don't want to buy treasury bills. Then where will they put their money in? Instead of buying treasury bills and stuff, they will give that money as loans to the private sector. Private sector loans, maybe they can earn, let's say, 8%, 10% interest. So they will give that. So you increase loans, money supply goes up, aggregate demand goes up. That's what is there over here, Lama, in number 4. When you have a very low discount rate, that is what happens. Okay. Right. 2017, question 33. Which of the following happens when the central bank reduces their policy rate? So policy rate right now is the overnight policy rate. But at this point, it was the standing deposit, standing lending. But anything, it works the same way, Lamai. So what happens if you reduce the overnight policy rate, or earlier it was the standing deposit facility and the standing lending facility? If you reduce policy rates, Lamai, what happens to other market interest rates? Market interest rates will, short-term interest rates, long-term interest rates, eventually, not immediately, but little by little by little, will also reduce, right? So other market interest rates will come down. So when market interest rates come down, now here the question is talking about demand for money and supply of money. So you all tell me, what will happen to demand for money? Forget about supply. Demand for money, we learned under speculative motive. If interest rates come down, demand for money under speculative motive has to increase, right? Remember, negative relationship, interest rates and demand for money, speculative. Interest rates have to come down, demand for money will go. And then what happens here, Lamai? When interest rates come down, what will happen to the amount of loans that people take? When interest rates are low, now you can get a loan at, let's say, 5%, 6%, you can get a loan. Loans will increase. As a result, what will happen to money supply? Supply of money. Supply of money will also increase. So then look for an answer that goes in line with this story. Number 1, demand for money decreases. No, demand for money will increase. Demand for money increases. Okay. Market interest rates increase. Does market interest rates increase? No, market interest rates come down. Supply of money decreases. Wrong. Supply of money increases. Market interest rate decrease. Correct. Supply of money increase. Market interest rate decrease. And looks right. Demand for money and supply of money and market interest rate increase. Market interest rate will come down. Demand and supply will go. Again, number. Then 2000 is another one. The primary goal of the Central Bank of Sri Lanka in the conduct of its monetary policy at present is what? This is the same goal, now also the same goal. What's the main goal of monetary policy? It's to keep what stable? It's to keep inflation stable. Stable at around what level? Prices stable, yes. At around a mid-single digit. Keep inflation stable at around a mid-single digit. So which one talks about that? Number 1. Stabilize inflation at a mid-single digit. Go through the slides I'm discussing. I'll go through, but on your end, Lamai, do the questions and come so that you just jot points when I'm writing, right? It's not to try to do it when I'm writing. Okay, 2017, 34 is done. Now we go to 2017. Now there's another one. What will happen to money supply and interest rates if the central bank sells securities? We know this again, once again, until you get fed up of it. CBSL, open market operation, they are selling government securities. So if they sell government securities, commercial banks, do they have to pay money or will they get money? Central bank is selling here, commercial banks have to now pay. So commercial banks, if they pay money, what will happen to commercial banks? You tell me, what happens to commercial banks? Reserves, or in other words, their liquidity situation? Their reserves and liquidity will come down, right? Now they have paid money. Now they don't have much of reserves. They don't have that much of liquidity. What can then happen to my interest rates? When they don't have that much of money, interest rates can start increasing, right? And then following up with that, what will happen to loans then? Commercial banks don't have much money. Interest rates are a little higher. Loans will now start coming down. Money supply will come. So we can stop there because the question talks about interest rates and money supply. So what's the final answer? Interest rates increase, money supply decrease. Which one talks about something like that? Answer number. Interest rate decrease. Sorry, interest rate increase, money supply decrease. Answer number 2, right? Decrease, increase. Okay. Now, then the next one. 2018. Which of the following is likely to cause an increase in the money supply in a country? Which of the following is likely to cause an increase in the money supply in a country? Okay. So we'll go one by one. A balance of payments surplus. There is a BOP surplus. BOP surplus, there is a lot of dollars coming into the country. What do you think can happen? If there is a lot of dollars coming into the country, those dollars will eventually get converted into rupees. What can happen to your money supply? With increase or decrease, money supply can increase. If you have a BOP surplus, a lot of dollars are coming in than the amount of money going out. So dollars coming in, that dollars have to get converted to rupees. You can think of it in a simple way like that. Then what happens? Your money supply can actually increase. So maybe that can even be our answer then. We look at the others. A government budget surplus. What do you think, Tawai? Government is running a budget surplus. They are cutting down expenditure. They are increasing taxes. Will that really expand the economy? That's more like a contractionary thing, right? So that can eventually end up leading to a money supply coming down. Then that is not the answer. Cash withdrawal by commercial bank depositors. If people start withdrawing money, can banks have the ability to give loans and all that? Can banks do credit creation? If people start withdrawing all that, if people deposit money, and the banks can do credit creation, money supply will increase. If people start withdrawing all their money, then banks can't do anything, no? So then not this. Money supply will come down. Then, yeah, currency held by public will increase, but you need to understand, when the money goes into the banks, it creates multiple deposits. Now, for example, if you deposited 100 rupees, currency held by public goes down by 100. But because of credit creation, demand deposits increase a lot. So money supply increases. Same way opposite here. If you withdraw money, yes, currency held by public will increase, but demand deposits will fall multiple times now. So this is like multiple deposit contraction that will happen. Okay. Then recall of loans. Recall of loans is the opposite of giving loans. When you give loans, money supply increases. If you recall loans, you have given a loan to a fellow, you say, then can't do this. That's the opposite of it, right? Money supply has to come down. Then selling government securities. That's what we did in the previous MCQ also. If the central bank sells government securities, what happens to the money supply? Money supply will decrease. So all of that then causes money supply to come down, right? No, deposits are not a part of high power. All of it will cause the money supply to come down. The only one that increases money supply will be your first answer, a BOP surplus. So if you have a lot of BOP surplus, so much of dollars coming in, the dollars get converted to rupees, and you have a lot of money supply in your economy. Okay. 2018, 31. Then 2018, okay, this has to be 34. I'm guessing in your PDF I sent, the number is a little wrong. Yes. Fifth one, can increase money supply in the long run? No, if you sell garments, it's contracting money supply. Yeah, so I think in your tute it's printed wrong. Make it 34, right? I'm guessing in the past paper it's 34, not 27. What are the key policy tools used by the central bank in conducting its monetary policy at present? So which one are the main ones, Lamai? Now, even right now, it's the same thing, Lamai. What are the main ones? You have a lot of monetary policy instruments, SRR, TNMA, open market operations, policy rates, you have moral suasion, you have bank rate. Which one is the most commonly used one, Lamai? Most used ones. Now, what did I even talk about today morning? I told you. What did they keep constant? What did they keep unchanged? I told you they kept the policy rate unchanged. What's the policy rate? The open overnight policy rate. So those are called policy rates. So policy rate is like the main monetary policy instrument. So apart from that, what else do they do? Which is the one, Lama, in all these past questions they have been talking about mostly? Open market operations. So policy rates is the main one. If they want to select one of it, you can say, oh, policy rate, that's the main monetary policy instrument. Apart from that, on a regular basis, they will have a lot of open market operations. So answer there will be number 5. These are the others are also there, but these are the ones that are mostly used. I'm not saying that a bank rate or moral suasion and SRR is not there again. But it's not a main thing. Credit squeeze, there is nothing called, it's not a monetary policy instrument. Credit squeeze is like reducing the amount of credit. It's like, you can think of it like qualitative thing where you don't give loans. Okay. So answer 5. Then 2019 question 26. Which of the following will lead to a decrease in the economy's money supply? We'll go one by one. Increase in income taxes. Sorry, a decrease in income taxes. A decrease in income taxes, Lama, is we're talking about a decrease in the money supply. We'll go one by one. If you decrease income taxes are low, consumers' disposable income is high. They will consume a lot, all of it. Is it? It might not have a direct impact on money supply, but overall, is it expansion or contraction? Might not have a direct impact though, but at least your economy is expanding. So you can indirectly say maybe money supply will go up, but not directly, but then that's not the answer. Second one, Lamai, a decrease in discount rate. I told you all this before now. If the discount rate comes down, we did it in 2 or 3 questions before. Will commercial banks like to put their money in treasury bills? Now, treasury bills are giving only 2% discount rate. Will they like? No. That means where are they putting the money? Discount rates come down, they are putting the money for private sector loans. So they're giving more and more loans. Giving more and more loans, your money supply will increase. So you're looking for an answer where money supply decreases. So then not 2. Third one, open market purchase of government securities. I think we did that the very first question. What happens if the central bank purchases? Commercial banks get money. Commercial banks get money, more loans, more reserves. Money supply will increase again. Then not this. Increase in the SRR. Could that be an answer? If you increase the SRR, can you bring money supply down? Yes, no. That is contractionary monetary, no? So if you increase the SRR, what will happen? if you increase SRR, what happens to Lamai? The liquidity in commercial banks. That means now commercial banks have to put from their deposits a lot of money they have to keep in the central bank as required reserves. So what happens to commercial banks' liquidity Lamai? The amount of money they have to give out as loans. They have to put a lot of money now in the central bank, right? Their liquidity or the amount of money to give out as loans will come down. Then your loans come down, money supply comes down, price level, aggregate demand, all of it comes down. So reduce money supply could be the answer. Increase in government expenditure, again, might not have a direct impact, but at least it is expansion. So you can say it will increase money. So answer number 2019 question 26. Next one. 2019 question 27. When an economy is at full employment, which of the following will most likely create demand pull inflation? So demand pull inflation, which one will actually increase? Oops. Okay, sorry guys, I had a power cut. Can you all let me know if you can hear me? Moved into a hotspot, can hear, right? So okay, until my current comes back, I will do it on my hotspot without the camera. Okay, because I think hotspot signal is not very strong. Give me a second, I will reshare my screen. Current has to go in this time also. Okay. You should be able to see a screen now. All good? Can hear, can see now? You just can't see my face. My camera is off. Okay. Right. So they're asking you, when an economy is at full employment, which one will most likely create demand pull inflation? So demand pull inflation is like something that will actually increase aggregate demand. So which one do you think will increase aggregate demand? An increase in the policy interest rates? Will that create aggregate demand to go up? No, no. If you increase policy interest rates, if you increase interest rates, money supply will come down, aggregate demand will come down. No. Increase in income taxes. If you increase income taxes, consumption will come down, aggregate demand will come down. A decrease in the real interest rate, can that be the answer? If you decrease interest rates, people will borrow, money supply will start going up. As a result, what can happen? Aggregate demand can go up. So that can be our answer. Then a decrease in government spending, no, that brings down aggregate demand. A decrease in money supply also brings down aggregate demand. So then that has to be number 3. Okay, so 2019 question 27 is 3. Yeah, previous one was 4. Then 2019 question 29. This is also a very interesting question. They're saying, if the government simultaneously engages in expansionary monetary and expansionary fiscal, which of the following is the effect on interest rates and unemployment? This is a bit of a tricky question. Okay, so first tell me, Lama, if they have an expansionary monetary policy kiyanne, what is happening to interest rates? Interest rates are increasing or decreasing? Interest rates are coming down. As a result, what will happen to Lamai? Money supply, aggregate demand, and all, it will increase. So then, what will happen to unemployment, Lamai? If there is so much of demand, firms are producing more, unemployment will, question is asking about unemployment will also come down. Okay. Then, that is expansionary monetary. Now, what if they also have an expansionary fiscal? Now, expansionary fiscal policy, the government is kind of running budget deficits, no? They're running budget deficits. They are increasing government spending. They're reducing their taxes. So as a result, what can happen to aggregate demand? Aggregate demand will increase. What can happen to unemployment? If they increase government spending, reduce taxes, they're promoting aggregate demand, unemployment can come down. So unemployment will decrease. Fine. So then by looking at this answer, you will say, sir, unemployment will definitely come down. And then interest rates, we only talk about in the expansionary monetary policy. Therefore, interest rates have to come down here. So then you will say, sir, decrease and decrease. But is there an answer like that? There is no answer, decrease, decrease. So this is a question there, the examiner wants you to think a little bit more. You know, the other part of this thinking is, now when the government runs a budget deficit, right? What happens, Lamai? They have to now borrow a lot. Remember the crowding out effect story. Government is running a huge budget deficit. They're increasing government spending, reducing taxes. So they might now have to come and borrow. They might have to borrow from whom? They might have to borrow from commercial banks by issuing treasury bills and all. What will happen to interest rates then, Lamai? Crowding out effect. When the government is running budget deficits, they are coming and borrowing huge amounts from commercial banks. What can happen to interest rates? Then interest rates can start increasing, right? So then, according to this, you're saying interest rates are coming down. Expansionary monetary. But if you have an expansionary fiscal policy, indirectly, government runs a huge budget deficit. They try to finance that deficit from banks and all, and the interest rates can increase. So which one of this is more powerful? We don't know. Is the interest rate fall that is coming from an expansionary monetary more powerful? Or is the interest rate increase that is coming from an expansionary fiscal more powerful? We don't know. So therefore, interest rates are what then? Interest rates are, unemployment is definitely coming down, but interest rates are indeterminate. We can't really say what exactly will happen. So then which one is your answer? Number 4. Previous one was 3. Yes, if you all missed a question, I'm going to check your past paper book. Otherwise, I had to always go up and down. Okay. And then 2020. Right. So we have a few more MCQs. After the MCQs, I'll give you a break. Okay. What are the main objectives of the central bank in implementing monetary policy at present? Easy, no? So which one? Objectives of the central bank. Price stability and financial system stability, price stability and full employment, price stability and sustainable development, full employment and equal income distribution, price stability and the reduction of public debt. Which one is the objectives? Price stability and financial system stability. So those are objectives of the central bank. Easy ones. Then the next one. Okay. Suppose the SRR is 10% and the central bank conducts an open market purchase of 300 million from commercial banks. What is the maximum possible change in money supply? Okay. So now, if the central bank does a 300 million purchase, money supply has to increase or decrease. Open market operation. Central bank purchases government securities. Come on, we did so many questions before, right? Central bank purchases, they are giving money to commercial banks, no? Money supply has to increase. They're asking you, what is the maximum possible it can increase by? So here, you can use your deposit multiplier, no? Because if the central bank purchases, that money will come into the banks. Banks will start giving out as credit. There will be credit creation that happens. So what's the maximum, Lamai? SRR 10% how much is our deposit multiplier? 1 over 0.1, we get a deposit multiplier of 10 times. So then this 300 can multiply by 10. How much is the maximum possible increase in money supply? Maximum possible increase in money supply will be a 3,000. So answer number 3. Yeah. That's what Can happen. Yeah. Then the next one. Okay, 2020 question 30. Monetary policy affects aggregate demand through changes in what? I showed you all this in a previous question. When you change interest rates and all in aggregate demand, what are the two components that get affected the most? Changes in direct and indirect taxes, share prices, export demand, consumption and investment, government spending. I told you what? When you change monetary policy, when you change interest rates and all, it is investment that mainly gets affected, but also consumption as well. So answer number 4. So those are very easy questions, no? Very direct questions. We have done this before also, kind of testing it indirectly in a different way. Okay, that's 2020. Now going to 21. Which of the following will result in an increase in the money supply? Okay, we'll go one by one. Increase in the standing deposit facility rate. What will happen now? If you increase the standing deposit facility rate, commercial banks would love to go and deposit money in the central bank, no? Because now central bank is giving a high interest rate. Then what happens to the amount of loans they might be giving to the public? Central bank is saying, come, put the money with me. I will give you, let's say, 15% interest. So commercial banks go and put all their money there then. Not enough money to give to the public. So loans come down, money supply will come down. So we are looking for something that increases money supply. Wrong. Selling bonds to commercial banks. What happens there? If you sell bonds, we went through this. Central bank selling bonds can now money supply will come down again. Now we went through this multiple times. I hope you all know the flow. So selling bonds can commercial banks have to pay. Commercial banks don't have money. Money supply comes down. Increase in the discount rate. If you buy a treasury bill, let's say you're getting a 30% interest now. Then what do commercial banks do? With all their money, they go and buy treasury bills. Then are they giving loans to the public? No loans to the public. Money supply comes down. Wrong. A decrease in the external assets of the central bank. External assets can be foreign reserves. So foreign reserves coming down, it might not have a direct impact. We'll leave it. We'll see if there's a better answer. Otherwise, we'll come to it. Okay. Last one. A decrease in the SRR. Can that be the answer? Yes, right. Remember earlier question, they had increase in SRR. So if you reduce the SRR, now commercial banks don't have to keep a lot of money in the central bank. No, required reserves are low. That means now Combank's liquidity, the amount of money they have to give out as loans to the public increases. Your loans increase, your money supply will increase. So that can be your answer then. A decrease in the SR. Fine. 2021-30. Answer number 5. Done. Then 2022. Which of the following policies will close a inflationary gap? So close a inflationary gap can in simple terms think something that will bring inflation down. Or in other words, that will bring aggregate demand down. So bring aggregate demand down can you would have a contractionary fiscal and a contractionary monetary. So look for answer that has like a contractionary fiscal and monetary policy that will then reduce aggregate demand and thereby reduce inflation and close the inflationary gap. Which one? Lower the reserve requirements. No, if you lower the reserve requirements, that is expansionary monetary. Raise reserve requirements, okay, contractionary monetary. And lower the discount rate. No, if you lower the discount rate, that is expansionary monetary. If you reduce discount rates, then commercial banks don't buy treasury bills and bonds because treasury bills and bonds are only giving, let's say, 2%. And they are going and giving that to the public. Then public gets money, money supply will go up. Then wrong. Here, when you say inflation gap, we learn in unit number 6. But here, when you say inflation gap, think about it as inflation. So think about which one will reduce inflation. Okay. The reserve story indirectly decreases money supply. What happens is now when your reserves and all change, remember central bank to buy reserves, sell reserves, they have to, release high powered money kind of. So it can have like an indirect impact, not a direct impact. And sometimes it's almost negligible kind of an impact. Okay, this one, increase money supply? No. You're looking for a contraction of fiscal and monetary. Decrease money supply, okay. Increase taxes, okay. Reduce government spending, okay. So something that talks about a contractionary fiscal and monetary. So which one? Number 4. Decrease in money supply, decrease taxes, nothing. Okay, that is that. 2022, question 30, part 4. Do you all realize the questions are getting easy? Do you realize the same thing that it's coming again and again and again? In different ways, they're kind of testing the same thing. Karakala, same thing they keep on asking. Then 2022, question 31. Which of the following will lead to an increase in the money supply? Okay, we'll go one by one again. Which one will increase money supply? A decrease in income taxes. A decrease in income taxes could be expansionary. But remember, that is still fiscal policy, right? So a decrease in income taxes can your disposable income will go up, consumption will go up, but you can't exactly say. That's why I said before also, money supply most likely can go up, but see if there is a better answer for monetary policy. If there is no better answer for monetary policy, then one could be our answer. So I will keep one for now. A decrease in the government budget deficit. That is anyway a contraction in. If you're reducing the government budget deficit, you're reducing government spending, you're increasing taxes. That's how you can reduce the budget deficit. So that can't increase money supply. Open market purchase of securities from the central bank. Can that be an answer? Central bank is purchasing government securities. Can be, right? All this time we discussed about it. No? If the central bank purchases, and you all know, no? So central bank, they have an open market operation. They purchase kiyanne. Com banks are getting money. So com banks get money. Com banks reserves increase. The amount of loans they can give can increase. Money supply will. So that can be the answer then. More direct monetary policy related answer. Increase in borrowing by the government by issuing treasury bonds? No, that's crowding out effect. If the government issues treasury bonds and all to banks and keeps on borrowing, now banks don't have money then to give to the private sector because they have to buy that treasury bonds. No. Increase in policy interest rates? No, you reduce policy interest. So 1 and 3 are kind of possible answers, but always go with the direct monetary policy related one. So direct monetary policy that will have a direct impact on increase in money supply will be open market purchase of government securities. Easy one. Then 2023. In a hypothetical economy, if real GDP is 10,000, full employment is 8,000, which of the following combinations might have brought the economy to this point? Now, you are having a what type of a gap? Is it an inflationary output or a deflationary output gap? Your real GDP is 10,000, but your full employment is only 8,000. You're at equilibrium above full employment or below full employment. A bit of unit number 6 here is involved. You're at equilibrium above full employment. So you're at equilibrium above full employment. Is it a inflationary output gap or a deflationary output gap? It's a inflationary output. Now, look at what is the question asking. Is the question asking us to how to reduce this inflationary output gap? Or are they asking you what caused this inflationary output gap? What are they asking? They're asking you which of the following combinations might have brought the economy to this point. They are not asking you may 10,000 in 8,000. How did it become 10,000? How did this inflation increase? How did you cause that inflationary output? What caused that inflationary output gap? So what caused the inflationary output gap, Lamai? But ideally, something that would have increased aggregate demand. Something that could have increased aggregate demand would have caused that inflationary output gap. What can cause an increase in aggregate demand? A expansionary fiscal or an expansionary monetary. So look for an answer that goes in line with that. Maybe if you had an expansionary fiscal and expansionary monetary, That is what would have increased aggregate demand. That is what would have taken your GDP above full employment. Look for an answer. Answer number 1. Decrease in taxes, okay. Expansionary fiscal. Increase in policy rates, then increase in policy rates is contraction. Wrong. Decrease in taxes, yes. Decrease in interest rates, yes. Decrease in taxes is expansionary fiscal. Decrease in interest rates is expansionary monetary. So because of that, aggregate demand would have gone up and your real GDP would have gone up and you would have ended up having a real GDP much higher than full employment. That can be the answer. We look at the others. A decrease in taxes, okay. Selling government securities, no. If you sell government securities, that is contractionary monetary. Wrong. Increase in government purchase, okay. Increase SRR, no. Decrease in taxes, okay. Decrease in government purchase, no. So see, answer number 2. Logically think. You logically think, Lama, you can narrow down and get your final answer. Okay. That's 2023-25. There's another one. Expansionary monetary policy implies which of the following about discount rate, policy interest rate, aggregate demand? Easy one. So if you want to have an expansionary monetary line, what should happen to discount rates? Should it increase or decrease? Discount rates should decrease, right? The lower discount rate can, now you're not getting that much from treasury bills and bonds now. You will put that money in the private sector. Money supply expands. What should you do with policy interest rates? If you want to expand the economy, policy interest rates, your SDFR, SLFR, now it's the overnight policy rate, it has to decrease. What will happen to aggregate demand if you have expansionary monetary policy? Aggregate demand will increase. So easy one, which one talks about this? Decrease, decrease, increase. Answer number 4. Okay. Discount rates, that's what I explained in detail, right? In case, I hope you were not daydreaming at that point. Probably when I upload it on YouTube at some point, go back to this 2017 question where I explained discount rates in detail. So discount rates in simple terms is the interest rate or return that you get on treasury bills and bonds. Idle treasury bills. Okay, that is also done. Then we go the last one. 2024. This one. Question number 30. The new central bank has debarred. Debarred means prevented the central bank from what? We have discussed this is a current context question. Has prevented the central bank from printing money, granting direct or indirect credit to the government, playing a role as a banker to the government, conducting open market operations, intervening in the foreign exchange market. Be careful with your answer. New central bank has. This is what happens when you listen halfway. Has the new central bank act prevented the central bank from printing money completely? So does that mean now the central bank can't print money at all? They can print money, but for what reason can't they print money? I told you that specifically. The new central bank prevents the central bank from printing money for what purpose? Printing money to fund the government, to finance the government. Government can't now run a budget deficits and come and ask the central bank, may gun a treasury bill like a print money and give. That is the one that you can't. You can print money to, buy foreign assets. You can print money to give loans to commercial banks. That is not a problem, but you can't print money for this. So which one talks about that, Lavai? Number 2, right? Granting direct or indirect credit to the government. That is what you can't do, Lavai. Not that you can't print money. You can print money. You can't print money to give loans to the government. That's a bit of a current context kind of a question that they ask. Now see, in the 24 A-level paper, there is no MCQ really from this kind of monetary policy instruments kind of thing. That's there. Bank to the government, central bank is the one who handles all the accounts and everything of the government. That still happens. That's not a problem. Discount rate is like capital gains share market. Kind of, not the exact thing, but if you want to think of it, yes. Indirect loans to the government is like government central bank giving money to commercial banks then giving it to the government. That's like an indirect thing. That also to some extent is prevented. You can't directly do that. Directly is central bank directly giving to the government, buying a treasury bill from the government. Indirectly is where central bank gives money to commercial banks use that money to buy a treasury bill or bond from the government. That also is kind of prevented. Okay, right. So that's the MCQs. How did y'all do out of all of this? There were 27 26 MCQs. Let's count and see. At least around the 16-ish, I feel is a decent enough mark. But ideally should have been more. But how much out of 26? 16-ish is a decent enough mark. But more the better. Okay, so you count and see. I'll say a decent enough is at least around 16. To count and see, thing you do and come. Otherwise, everyone has 26 out of 26, no? Okay. So we'll take a break. And then we'll come into the essay questions. I also still don't have current. I will continue without. I have battery on my devices, no problem. So I will continue without the camera. So we'll take a break for 10 minutes. The class is until around 11. Essay questions, again, there are very interesting questions. Some of it is repeated. It's 9:40. We'll take a break until 9:50 and come back. Yes, on Friday, we are starting unit 8. Yeah, decent mark means if you can do a little bit more in the next 2 months, you can get an A. So take a break until 9:50 and come back. We'll start the essay questions. Okay, right. So we'll get started, guys. We'll get started with the essay questions of monetary policy. I still don't have current. Apparently current is gone until around 5 o'clock today. I didn't know. But I think that's more than enough. I have enough and more battery to get the class done for the next 1 hour. So we can finish off the essay questions and we can wrap things off. How do we invest in the, I think it's only in my area. I mean, Mount Lavinia, I think it's the specific road. Okay, I think maybe maintenance or something. How do you invest in stock markets? You ideally have to get in touch, Lamai, with a stock broker firm, right? So there are multiple stock brokering firms. You can get in touch with one of them and they will help you out. Or you can do it alone as well. You can do it alone, you can create your own CDS account, right? You have to create your own CDS account. But then in your CDS account also, you have to select a stock broker. You can't directly buy stocks on your own. You have to go through a stock broker. So if you have invested, let's say like very little amount of money, then manually you have to call the stockbroker and tell him to, buy this stock and all of it. But if you have invested a certain amount of money, usually, let's say more than 100,000, they give you access to their online platform. So there you can buy and stuff as well. So maybe if the stock exchange is something that you're interested in, look at it after A levels. And then after A levels, when you're free, learn how to invest. Yeah, you can invest in shares. It's halal as long as it depends on what firms that you put in. So if you, let's say, if you don't want to put it on interest earning firms, you can put it on, there's so many other firms. It's completely fine. Right. Yes, nice. Stockbroker Tasha Phillips. Nice. So there are multiple stockbrokering firms now. You can select anyone. They will help you out. So the stockbrokers also sometimes will tell you some good stocks to buy. They will do their stuff as well. So learn it immediately, maybe after A levels. It's not about making money. Immediately after A levels, it's about learning it. So work on learning it. So let's say you spend 2-3 years properly learning, and then let's say 5-6 years down the line, you can start making money out of it. Because immediately after A levels, you're not going to have a lot of money also. No? Not that you have millions and millions saved up money to put in the stock exchange. Maybe all will start with, let's say, 10,000, 15,000, put 5,000. You will start with a small amount. So in that small amount, you can't live the entire month. No, man. So that amount, use it for your studying. So there are online courses. There are even so much of videos on YouTube as well. Even videos in Sinhala explaining how the Colombo Stock Exchange works. Okay, so we'll get into the essay questions, starting with the 2011 one. Now, one thing you need to understand, Lamai, some of these questions are current context questions relevant for that year. So then some of these you all might not even have heard. It might not even be in your tunes because we're talking about past papers from 2011 onwards. That is around 14, 15 years ago. Okay. So 2011 A-levels, all of this, remember, is from question number 6. Harida, I have not typed the main question number 6. So question number 6, part 5. This is again a bit of a current context question to start with, Lamai. 3 lending programs implemented by the central bank to promote regional development and poverty alleviation. Now, 2011 is a period where, Lamai, we were focusing a lot on this. So that is in a time where you had the war was over and all of it. So the answer for this, Lamai, I'm not giving it from the marking scheme. I took it from, I think, a recent one. And that is where the COVID-19 ones are also there. So if you look at this now, you will wonder, how did COVID-19 come in this? So these are a few ones, not from the 2011 marking scheme. This is something at least 2-3 years ago, the different programs that the central bank had. I doubt. I think this can be a kind of question for your one. Okay, so just have that in mind. So there is this new comprehensive rural credit scheme. There's something called Suashakti. There's something called Saubhagya. They have different things that you can just remember, maybe 2 or 3, but very unlikely that it will show up in your paper. Okay. Outline 2 reasons or factors, give 4 marks. Isn't enough for you to write the 2 reasons. So write the 2 reasons and product, explain that in 2 to 3 lines. That's what you do in outline. Okay. Then 2012 question 5. Explain how open market operations are conducted by the central bank to contract money supply. Remember, Lavin, what we did in the MCQs? That story is what you have to talk about, Lavin. So what is open market operations? Open market operations is where the central bank buys and sells government securities in order to control the amount of liquidity or money supply in an economy. So if the central bank wants to contract the money supply, Lamai, what should they do? Should the central bank purchase or should the central bank sell? If they want to bring the money supply down, central bank has to sell government securities. So now explain the story thing. Remember that flow chart that I would have taught you. So now that you have to write in your own words, Lamai. That's what you should do. Central bank has to sell government securities. So then you can say, in order to contract money supply, central bank has to sell government securities. In other words, the commercial banks would then what? The commercial banks would then purchase these securities, which means the amount of liquidity that commercial banks will now have will start coming down. And as a result of this, what will happen? Commercial banks will be less able to what? Less able to lend. Now they don't have much money, no? So now they can't give much loan because they don't have money. As a result, what can happen? The loans in the economy can reduce, thereby causing a decrease in the money supply. So that story, idly break it down to, let's say, around 2 paragraphs and explain the story. That's how open market operations lead to a contraction in money supply. So we did this in the MCQs, right? Same thing, they are now converting this into a essay question. So for essay questions, again and again and again, I always tell you, you have to write, Lamai. If you're not writing, just listening to me and looking at these arrows is not going to help. You have to put pen on paper and write. You put pen on paper and write. That is where, Lamai, that is where your flow and all of it will start improving. Yes, you can say commercial banks will use taxes and purchase. Correct. Okay. Then going to the next one. 2013 question number 6, part 3. What are the major categories of financial institutions? Institutions that make up Sri Lanka's financial system. In the previous one, yes, better to give a little bit about what is open market operations and then start explaining. Good. So can you tell me what are the major categories of financial institutions in Sri Lanka? You have the what? How are you going to break this down? quickly. You can break this down. There is no one correct answer here. You can have multiple answers here, right? So you have, for example, you can say regulated by central bank and not deposit taking firms, non-deposit taking firms. You can even start, if you want, you can even start with the central bank. Right? Central bank is more like a regulator, but you can give that as a financial institute as well. And then you have what? Institutions regulated by the central bank. I'll give you a I'll quickly share my tute take breakdown. So you can take a screenshot of that. It will be there. Give me a second. Let me try to get this one. The different institutions. Okay, so you can use this. We try to put in an answer from my tute. You don't have to write it this much in detail, but it doesn't have to be this much in detail, but at least to some extent, you can talk about it. Okay, so this is just a copy and paste from my tute. So you have the central bank, institutions regulated by central bank. Under that, you have deposit taking institutions, the licensed commercial, specialized finance. You have the other financial institutes, all of that. So I feel even writing the main ones, right? When I say main ones, maybe this, talking about, let's say, the contractual savings, I think those should be enough for you to get your 4 marks. You don't have to write this entire breakdown only because they are saying main categories. No. So you can write it in multiple ways. You can refer to the marking scheme answer as well. They will have. This is in the theory tute. I can't remember the page number. In your 2025 Unit 7 theory tute, this one is there. Okay. Then 2014. What are the objectives of the central bank and explain how are these objectives achieved? Okay. We'll talk about it right now. So the objectives were the same earlier also, but now there is something called co-objective and other objectives. What is the co-objective of the central bank? No, financial institutions will not be there. You'll have to talk about what's inside it. The co-objective is price stability, right? Domestic price stability. What is the other objective? That is your financial system stability. So Anna, you have to talk about it, right? So I'll just show you the direct story. No, protecting liquidity profitability, that is objectives of commercial banks, not central bank. So give me a second. I'll get directly from the central bank website itself. So you can talk about this. Objectives of central bank. You can even take a screenshot of this. If you want, I will have a picture of this. So central bank's core objective and this one. How do I copy this? To paste it. It's not allowing me to paste. Okay. Right. So then I will go through the question again. You can take a screenshot of it. I'm not going through the answer one by one, but what are the main objectives of the central bank? Remember, there are two objectives. One is called the core objective, that is achieving domestic price stability. And then you have the other objective, securing financial system stability. Now, that's a small change that happened earlier. Protecting liquidity and profitability, those are objectives of commercial banks, not central bank. Okay. So then, how do you have domestic price stability? So they're asking you, explain how are these objectives achieved. So how do you maintain price stability. You maintain price stability using your monetary policy, no? So using your monetary policy instruments are mainly your overnight policy rate, right? By controlling the interest rates and the amount of money supply in the economy, that's how you control the prices in economy. So you have to talk about that. So how is it achieved? So how is this part achieved? Using your monetary policy. So using monetary policy, they control interest rates and the money supply, and thereby they control aggregate demand and control the prices. So you talk a little bit about it as well after talking about what the objective is. Then how do you achieve what is financial system stability? Financial system stability is about how keeping the entire financial system stable, right? The financial markets, the financial institutions, making sure all of it is stable and it doesn't really collapse. So how do you do that? To have financial systems stability, the government has what? The central bank has regulations, they have rules and regulations, they continuously monitor, right? There are certain standards to be met. So all of that you can talk about. So come up with a nice answer for this. It's not a difficult question. You have to write. The more you write, the better you will get. Okay, then 2014 question 5. Explain the qualitative control measures used by the central bank in order to control money supply of a country. Give me a second. The qualitative credit control measures. We'll go one by one. Give me one by one. What can you talk about? You can talk about, let's say, moral suasion. What is moral suasion, Laman? So moral suasion is like more like guidance, right? So it's like where the central bank, guides commercial banks in order to achieve the central bank's objective. Central bank says, look here, I want to reduce inflation right now. So commercial banks, can you please, right? Can you please reduce the amount of loans that you're giving? So it's not a strict rule or regulation. So not strict rules or regulations. So you can talk about that. So for around 2 to 3 lines, if you explain Lama, that is enough. Okay, what else do you have? No, policy interest rate is not qualitative. Policy interest are quantitative. You have credit limits. So credit limits is Lama maximum credit limits. So you can say, for example, for importers, maximum you can, let's say, give only a 1 million loan. Don't give loans more than that. That is what you call a credit limit. So you can impose credit limits on this as well. Apart from that, collateral requirements. So collateral requirements are also this thing. So you can increase, decrease collateral requirements can limit your securities and all. Right? If you want to get a loan, you have to sometimes give your house as collateral. You have to give a land as collateral. So if you increase the collateral requirement, it's very hard to get a loan there. So then money supply will come down. But if you reduce collateral requirement, then it's easy to get a loan. Then money supply will expand. So collateral requirements are there. Apart from that, maybe one more should be enough. No, limiting credit is not quantitative. Credit limits are qualitative. So you can even control the direction of bank credit. So you can talk about that, controlling the direction of bank credit, where the money goes. Right? So you can, do that. Maturity periods, extending maturities, yes, that is also fine. Anything else? Yeah, so whatever that is there in your tute. So what you can do is, here ideally they would have not expected you to explain 5, even though it's a 5-mark question. Maybe around 3 of it. If you have put that, gone in detail and explained, that should be fine. Credit limit is no, it's not limiting imports. It's about, for example, maximum amount of loans that you can give. So you say, okay, banks, maximum you can, for example, give 100,000 loans for importers, something like that. That's called a credit limit. Moral suasion, yes, that also control credit. The moral suasion, what happens now? It's like more guidance now. So central bank tells the commercial bank, look here, please do this now. Now remember, we talked about in the class, remember the example where central bank cut policy rates, but commercial banks haven't really reduced their interest rates yet. And then the central bank governor wrote a letter to these PLOs. I told you, Central bank governor wrote a letter to all the commercial bank fellows and told, look here, I have reduced my rates. So you all also please reduce your interest rates now. That's more like moral suasion. No, credit limit is not only connected to import, it can be for anything. Okay, now, right, done. The next one, 2015 question number 5. Now, this again is a bit of a current context question. Why there is very high levels of liquidity in the domestic market in Sri Lanka at present? That is 10 years ago in 2015. They're asking you why there was so much of liquidity. What measures have been taken by the central bank to absorb the excess liquidity? Now, I will try to connect this to our current situation and see. In 2025, I think it's a little bit applicable again. So in 2025 also, the amount of liquidity, amount of money that is there in the economy, the money supply in the economy is pretty high. Can you tell me why? Can you give me some reasons? Why do you think there is a lot of money in the economy? Why is the liquidity high? Money printing? Not really. There's no money printing happening now. Earlier would have been, not now. So now you can talk about what? You can talk about one. So reduced policy rates. So policy rates, they have brought down. That could be a reason. What about SRR? They have reduced the SRR. SRR is at 2%. Then there is so much of BOP surplus, right? So you have a BOP current account surplus. So there's a lot of money coming in from remittances, all of that. So that is coming into the economy. That is increasing money supply. Government spending, not a lot is actually happening though, right? So I won't give that as an answer. Anything else? There's also this, there is also the higher amounts of government revenue. Do you all remember in some class I showed you all, I think in the seminar, right? Do you all remember I showed you all these deposits of the government in commercial banks? Do you all remember that? I showed you a chart where I told you government has around 1 trillion of deposits now in commercial banks. To you all only, right? So that's a lot of money, right? So all of that money right now is where? Right now is in the Bank of Ceylon. So that money is then going into repo markets because the banks will not just keep it with them. They will put it here and there, right? Repo markets, small things. So there is a lot of money there. So that government revenue is coming in the form of deposits to commercial banks. But these are product advanced points though at your level. But those are kind of things. Then that's the first part of the question. Why is there high levels? Second part, what measures have the central bank taken to absorb excess liquidity? Right now, the excess liquidity is not really a big problem. So right now, they are not really taking any much measures. There is not much measures that they're taking. But if this excess liquidity becomes a very big problem, then they will have a contractionary monetary policy. They will increase policy rates. They will increase SRR. They will do all of that. But right now, this second part of it is not happening in Sri Lanka. The first part, to some extent, yes, there is a lot of liquidity. So I'm just trying to connect this 10-year-old question to the current situation right now. Okay. Okay. So I will leave it there because that's a current context question for that year. It's not relevant now. Then 2016. How does the Central Bank of Sri Lanka operate the standing rate corridor to control interbank call money market interest rates? Remember, this is an interesting story, right? So I'll just explain the story overall. And then, because there are multiple questions from this interest rate corridor, after that, I'm not going to explain in detail. So if you all know, there is this interest rate corridor. The upper boundary of this is the standing lending facility rate, and the lower boundary is the standing deposit facility rate. Between these two only, the call money market, interbank call money market, the average weighted call money rate keeps going up and down. So because of this interest rate corridor, what happens is you can control the average weighted call money rate. So I'll explain to you how this works. So first I'll explain to you why does the average weighted call money rate go between these two, right? We'll start with that. First of all, what is the average weighted call money rate, AWCMR? Average weighted call money rate is when banks borrow from another bank. Now, usually if banks run out of money, what they do is they borrow money from another bank. And they soon call another bank and say, look here, I want some money. And they borrow it. And within, let's say, a few days, that loan is settled. That's called a call money facility. Now, that borrowing also happens at an interest rate level. Let's say commercial bank will not give a loan to the Bank of Ceylon at zero interest rate. They will also charge interest rate. So different banks for different transactions will charge different interest rates. The weighted average of that is what you call the average weighted call money rate. So in very simple terms, you can think of the interest rate charged when banks borrow from each other. These like the average interest rate charged when banks borrow from each other in the call money market. From each other. So you all know the story. So then what is the standing deposit facility rate? Standing deposit facility rate is if commercial banks have excess liquidity or excess money with them, they can deposit that money in the central bank. If they deposit that money in the central bank, they will get an interest. So the interest received by commercial banks, by banks for depositing their excess liquidity. So whatever excess money they have, they can go and deposit in the commercial bank using the standing deposit facility. The interest that you get for that is what you call the standing deposit facility rate. Similarly, what is the standing lending facility rate? Standing lending facility rate is the interest that you have to pay. Interest paid when borrowing. If the commercial banks are running out of money, what they can do? They can taggala borrow from the central bank using the standing lending facility. Then central bank will lend money. When central bank lends money, what happens? Commercial banks have to pay interest. So when borrowing, I'll just keep it like that. At the basic story, you all know Lamai. So how does this work now? Now let's say there is a commercial bank. Okay, can you all tell me right now how much are these two rates? How much is the standing lending and standing deposit as of now? So today the morning rates didn't change. How much is the standing lending and deposit facility rates? In Sri Lanka right now, it's a 8.25 and a 7.25. So standing lending is 8.25%. Standing deposit is 7.25%. And I'm telling you, average weighted call money rate has to go between that. And right now, Nama, you have something called the overnight policy rate. So the overnight policy rate is trying to reduce the fluctuations of the average weighted call money rate even more. That's at 0.75%. So then, yeah, the rates I these rates don't change every day, Lamai. The standing deposit and lending doesn't really change every day. Okay, so that changes in the monetary policy review meeting, but treasury bill, treasury bond rates and all change every day. I usually keep a track on that. Not for my class work, for my office. So let's say there is a commercial bank that has, Lamai, a shortage of liquidity. Shortage of liquidity. Can you all tell me now what can they do if they have a shortage of liquidity? One option is call money market. Right? They can call another bank and they can ask. Another option is, Lamai, they can use the standing lending facility and pay the standing lending facility rate. So then let's say now standing lending, that one is fixed element. Standing lending facility rate is 8.25%. Now just think and practically think and tell me. Okay, practically think and tell me, Lamai, if the standing lending facility rate is at 8.25%, that means if you run out of money, you can borrow from the central bank at an interest rate of 8.25. Now, if you are to borrow from a commercial bank, what should the interest rate be, Lamai? If a commercial bank is saying, I will give you a loan at, let's say, 9%, will you ever borrow from another bank in the call money market? You will be like, go fly a kite. I can get from the central bank itself at 8.25. Central bank itself is willing to lend to me at 8.25%. So if you're going to give me call money, right, within the banks, you have to give me less than that, right? So then if the call money facility is to work, Lamai, the call money rate has to, let's say, for example, let's say 7.75, has to be less than the standing lending. The average weighted call money rate has to be less than the standing lending facility, because otherwise the call money facility won't work, Lamai. Because from the central bank itself, you can borrow at 8.25%. Why will you borrow from another bank at, let's say, 9%? You're not going to do that, right? So, as we comment will vary for deposits and lending. No, this is the average number. So, average is one number. That each transaction will have a different rate. Here, this is the average number. Okay. And then, same way, let's say if there is a commercial bank that has excess money, now what will happen? Let's say there is a com bank that has my excess money. What can they do? What are their two options? One is, again, they can lend it in the call money market. They can give it to another bank, or they can use the standing deposit facility. Standing deposit facility, right now the interest rate is how much? Right now the interest rate is 7.25%. So if you have excess money, if you go and deposit in the central bank, you're getting 7.25%. If you're going to give this excess money to another bank, you will want how much percent? You will want more than the central bank. Now just think, I have excess money. That excess money, if I put in the central bank, I can earn 7.25% interest. Then if I am to give my excess money to you, let's say you are another bank, I will expect more than that, because from this itself, if I can get 7.25, if I am to give it to you, I will say, look, yeah, I want more than this. Then let's say again, a 7.75. So that's where the average weighted call money rate, average weighted call money rate, average weighted call money rate has to be greater than the standing deposit. That's how the interest rate corridor is formed. So between that 7.25 and 8.25% tamai, your average weighted call money rate will always keep fluctuating. So average weighted call money will always be between that. So that's a pathway, that's like a corridor. That's the logic behind the interest rate corridor. So with that corridor, what happens is, you prevent the fluctuations of the average weighted call money, because otherwise the average weighted call money, that is one of the main short-term interest rates, it can fluctuate a lot. It can be, for example, today it can be 6%, tomorrow 9%, day after tomorrow 13%, then again coming back to 5%. So if it's fluctuating a lot, that's a problem. So in order to keep this average weighted call money rate stable, that is why this interest rate corridor has been formed. So now the average weighted call money rate will only fluctuate between what and what? Will only fluctuate between that 7.25, 8.25. It's not going to go above that or beyond. Okay, that's the logical story. Then we'll talk about this. What happens? Let's say, your average weighted call money rate is increasing now. It is coming very closer to this upper boundary. Let's say average weighted call money is somewhere around here, coming very close to this upper bound. That is an indication of what, Lamai? That there is a shortage of liquidity, or does the banks have excess liquidity? Why do you think now within banks, within banks, Lamai, when you call another bank and say, can I get a loan? They're like, hari loan na denna, I want 8.23%. Why do you think they are quoting very high interest rates? Because they also don't have money, right? Because they also don't have money in the time. They are saying, Ari, mama dennang, 8.24. So average weighted call money rate is increasing. It indicates a what? Indicates a shortage of liquidity. But if there is a very high shortage, another what can happen? Average rate can start increasing. But what will the central bank do in a situation like that? If the average weighted Coleman rate is continuously increasing, it's coming very close to that standing lending facility rate. There's a shortage. No? What will the central bank do now? CBSL will inject liquidity. How will they inject liquidity? They will inject liquidity using the standing lending facility. There is a shortage of money. That is why the average weighted call money rate is going to touch that upper boundary. So the moment it goes to touch that upper boundary, and the central bank will inject liquidity using the standing lending. The central bank will lend money now to commercial banks and give them money. And as a result, what happens? Then the interest rates again start coming down. Same way, what if the interest rate is going to touch the lower boundary? Let's say average weighted call money rate now is at, let's say, around 7.26%. If you call a bank and say, they are like, hari, remember then 7.26%. What does it mean? What does that indicate? If the average weighted, I don't have space, I'll put it on the side. Average weighted call money rate is coming down. It's touching that lower boundary. What does that mean? It indicates excess liquidity. So what will the central bank do then? Central bank realize, these fellows have a lot of money. That is why the average weighted call money rate is going down. What will the central bank do? Central bank will absorb the liquidity. How do they absorb the liquidity? CBSL absorbs the liquidity using what? They absorb the liquidity using the standing deposit facility. They say, you have money now. Now come and deposit it with me. The standing deposit facility again. Go and put that. So that's how it works. That's how they keep the average weighted call money rate stable within that interest rate corridor. If it's going to touch the upper boundary, central bank will inject liquidity. If it's going to touch the lower boundary, central bank absorbs liquidity and they keep it. And now what has happened is, now earlier this standing deposit, standing lending were called the policy interest rates. No? So now earlier, when you say policy interest rates, it is between 8.25 and 7.25. So then now the average weighted call money rate, at what level should you keep this? You're not sure. Should you keep it closer to 8.25 or should you keep it closer to 7.2? There is a bit of a communication kind of a issue there. So that is why now newly, right? We talked about this in our seminars. We talked about this in our class as well. They have newly introduced the what? Overnight policy rate. So the interest rate boundary is still there. The corridor is still there. Not that the corridor is not there. But now they have introduced a new overnight policy rate. That is, transactions don't happen. This OPR is just the indicative rate. There is no interest rate actually being paid or received at that OPR. So now there is the OPR at 7.75%. So now that is a signal that the central bank is saying, we want to keep the average weighted call money rate closer to 7.75%. That is my policy rate. So I want to keep AWCMR closer to this. So the introduction of the OPR, it might reduce, right? That is still too early to say, but it can reduce the fluctuations of the average weighted call money rate even more now. Now earlier, if it fluctuated, let's say, between 8.25, 7.25, but now it will fluctuate, let's say, very closer to this, right? Now, even if it goes a little bit above 7.75 or a little bit below 7.75, the central bank will now take action. So it improves the communication of monetary policy even more and keeps interest rates even more stable. That is kind of the objective of why you introduced the new overnight policy rate. So yeah, that is the story. So the question again, coming back to my question now, how does the central bank of Sri Lanka operate the standing rate corridor? So there you talk about the standing lending facility, the upper boundary, standing with the lower boundary, average weighted call money rate fluctuates between that to control the interbank call money interest rates. So you can say within this boundary, all interbank call money rates will go. If the interbank call money, the average weighted call money rate starts going up, then what happens? They will use standing lending and inject liquidity. If the average weighted call money rate is going down, that means there is a excess liquidity, then they will absorb the liquidity. That story is what you have to talk about now. So this story is something that they have tested multiple times. Even in the recent A-level paper, there is a question. The main objective of the overnight policy rate is to improve monetary policy communication, to make it more clearer as to what the central bank really wants. Okay. To control the interbank call money market interest rates. Yeah, they have mentioned credit control. Credit control, what do you mean? If a question comes like this, if you present, yeah, draw a graph and all, and you can explain the story line. Understand the story logically. And now, after you've understood this logical line, now go and read the answer in your marking scheme. There is an answer. No? So now when you read the answer in the marking scheme, it will make sense. Sir told this, make thamai thiyenni kiyala. Then close the marking scheme and write your own answer. If you have not yet done it, then do that. Understand it, read the marking scheme, what is there, close the marking scheme, and then you come up with an answer. Come up with an answer even better than what the marking scheme has. Right? That's the interest rate corridor. We went through this in our seminar as well. When the average mean call rate is on its highest, no, SLFR won't change unless the central bank comes and changes. Okay, then go to the next one. 2017. 2017, question 5. Briefly explain the focus of the current monetary policy framework of the Central Bank of Sri Lanka. I will answer this based on the current one, not based on 2017. So when you say my current monetary policy framework, what's our current monetary policy framework called? What is the name? It's called the Flexible Inflation Targeting Framework. If they ask about framework, you talk about Flexible Inflation Targeting Framework. We call it FIT, Flexible Inflation Targeting Framework. So what is this flexible inflation targeting framework? These are directly in your tudes. Copy paste. So flexible inflation, I'll just explain it verbally. Flexible inflation targeting framework is where the central bank will publicly announce their inflation target. Now our central bank has publicly announced and said they want to keep inflation at a mid-single digit. That is, keep inflation at around how much? At around the 5% mark, with a plus or minus 2% variation. So that means between 3 to 7%, they are okay if inflation comes. After they publicly announce their inflation figure, they will use whatever policy tools, right? Right now they have the overnight policy rate, they have SDFR, SLFR, they have open market operations, SRR. So they will use all their policy tools in order to keep inflation at that desired target. So on a operational basis, on a day-to-day basis, they will try to control this lamai. They will try to control this average weighted call money rate. Because remember, I hope you all know the other bigger story. By controlling the average weighted call money rate, you can end up controlling lamai the other short-term and long-term market interest rates. If you can control market interest rates, then you can control money supply. You can control aggregate demand. You can control prices. So if the central bank is to control the price level, they start with this, their overnight policy rate. That will go and affect the standing deposit and standing lending facility. That will then in turn affect average weighted call money rate. That will affect the short-term and long-term market interest rates. That will then affect your borrowing and all of it, and will affect money supply. That will affect aggregate demand. That will affect price level. That's what they do, Lamai. So on an operational target now, on a day-to-day level, my central bank can't control prices. On a day-to-day level, what they do is they try to control this. By controlling this, by keeping this stable, they make sure everything else falls into place. So that bigger story we have talked about in class. I'm not going through that bigger story here, but you don't have to try the bigger story. Just talk about flexible inflation targeting. Would have liked if this was a theory class, I would have gone in detail, but we don't have that much of time. But most of you all were a part of the special seminar. You all are part of my theory classes. You at least have the recordings of my theory classes. So go back. You can watch the recordings. If you are, I will 95% of you all either have one of those. Okay. Then 2018. 2018, question number 4. Question 6, part 4, easy one. What is meant by monetary policy? So what is monetary policy now? Monetary policy is the what? Is the what? Easy question. Sometimes 3 marks ganna bad. What do you write? How do you define or what do you talk about? Monetary policy we can talk about is how the central bank, right, is the process of controlling what and what? Process of controlling the money supply and the cost of money. Cost of money yani the interest rates in order to do what? In order to achieve price stability. So you can for that explain that little bit in detail. You can talk. It's a 3-mark question, not a 4-mark question. So basically talk about what is monetary policy. Monetary policy is about how you control, how the central bank controls the amount of money supply in the economy and the cost of money. In other words, the interest rate. Why do they do that? In order to achieve price stability. Then you can say, you can talk a little bit about there are these monetary policy tools, just to expand your answer if you want, but not needed also. Okay, done. Then the next one. 2018 question number 5. Distinguish between quantitative and qualitative credit control methods. Now, quantitative we have all of this. The overnight policy rate, standing deposit, standing lending, the SRR. So all of that goes. Open market operations, all of those are there. Qualitative we had a question before. Moral suasion, controlling bank credit, changing collateral requirement, and all of that. So now they're asking you to distinguish between the two. So how are you going to distinguish now? Quantitative. Quantitative tries to control the what mainly? Yeah, that answer is good. So quantitative it mainly tries to control the volume of credit, right? So in other words, it tries to control the volume of the amount of money that is there, right? So, and quantitative is non-discriminatory. It will affect everyone equally. If you change the SRR, it will affect everyone equally, right? It tries to mainly control the volume, how much of credit is actually there. By increasing SRR and all, you can directly control that. But in qualitative the main focus is, yes, you can control volume also, but the main focus in a qualitative one, like when you impose maximum credit limits, when you do all of that, the main focus is to control the what? Not the volume, mainly the direction of credit. Where does the money go? Does it go to the agriculture sector? Does it go to the importers? Does it go to tourism sector? Where does it go? Right? And these are discriminatory. Discriminatory it can only affect one industry. Now, if you put a example, a maximum credit limit on importers, then only importers are impacted from it. So that is discriminatory. So that's what can actually happen. So for 2 marks, talk about quantitative. For 2 marks, talk about qualitative. You can refer to the marking scheme, get your points, write your answer. Done. Then the next one, 2019. 2019 question number 2. Explain the concept of inflationary gap using a diagram. Now, this is actually coming from unit number 6. But since inflation is kind of connected, you saw this inflation gap kind of MCQs also there. That is what they're talking about. So what's this inflationary gap? Now, inflationary gap is where your actual output is above your potential. So your ideally, let's say your full employment level of output is YF, but you are at, sorry, my screen went off. I got a call. I think that's why it went off. Hold on. Okay, sorry guys, I got a call in the middle. My hotspot got disrupted. Okay. Coming back to my question. Business is control credit. Volume is quantitative. No, so when you say sorry, controlling, did my screen go again? Okay, give me 1 second, guys. My screen keeps going up and down. Yeah, so controlling volume is that's exactly what I said as well, right? Controlling volume is amount of this one. Yeah, so controlling the volume lama is quantitative. Controlling the direction is qualitative. So volume is the amount of loans that you are giving up. So let me come back to that question. 2018, this one, right? So quantitative is mainly you control the volume, the total amount of credit that is there. In qualitative, you mainly focus on the direction. Okay. Right. So then coming back to this one, the 2019 question, I'll re-explain. Explain the concept of an inflationary gap using a diagram. So inflationary gap, you all know, Lama, is where you are at equilibrium above full employment. So let's say if this is your full employment level, but you're at equilibrium at this point. So you're at equilibrium above full. This is called the inflationary output gap. But they are only talking about inflationary gap now. So then you can give this gap, the gap between the two expenditure curves. That is your inflationary gap. That's what they have marked. So draw the proper diagram what you have learned, Lama, in 26. So what is inflationary gap then? Talk about it. So inflation gap is where your aggregate expenditure or your planned aggregate expenditure required for full employment, you have more. Your expenditure is more than what the expenditure needed for full employment. So E1 is the expenditure needed for full employment. But your expenditure is actually much more than that. And that is what in our MCQs they asked us, how do you reduce this? So how do you reduce this aggregate expenditure? I told you to reduce aggregate demand, to contract the economy, what should you do? Contraction, fiscal, and monetary policy. So here it's better to give it with the y equals E diagram. It's better to give it there rather than the aggregate demand and aggregate supply. Okay. Okay. Leaving it there. Then the next one. So same story here. It is kind of continuing in number 6. Agreed. Explain the role of standing rate corridor in maintaining the stability of the financial system. Same story, Lamai. What you all explained before. So here, that's why I copied and pasted the answers. So talk about what is the standing rate corridor. Same this thing I explained in detail. You have to write. Right? So what happens in the standing rate corridor? You have to talk about how it helps keep interest rates stable. So when interest rates stable, now in the standing rate corridor, if you're running out of money, you can borrow from the central bank. If you're having excess money, you can lend to you can deposit in the central bank. Right? You talk about those. You talk about those. You talk about how it keeps interest rates stable. That is the thing that you're right. The same story they ask it in multiple ways. Right? We have discussed this before. The previous slide again, if you want to take a screenshot, it's just all over the place, but yeah. Okay, so then going to the next one, 2020 A-levels part 4. Daily auction means your repo markets. So usually you have the call money market, repo market, daily transactions that you do. So at the end of the day, if you have excess money, and you can go and put in the standing deposit. At the end of the day, if you have a shortage, you use the standing lending. That's what the after the daily market. Okay. State 4 core functions of the Central Bank of Sri Lanka. Easy, lemon. What can you give as core functions of the central bank? Just a state here. Yeah, don't talk about agency functions. Core functions. So talk about the main core functions. Try to copy and paste. Okay, so these are a few things that I have given in my tute. Don't worry about this. That's my bullet points made of this one. Okay, so a few things, right? Conducting the monetary policy, right? Conducting the exchange rate policy, lend of last resort is fine, issuing and distributing the currency, right? Printing money, regulating the banks, right? So all of it, any point you can give. How is it? Okay, don't worry too much about the formatting of it, but yeah. Then 2021, 21, question 6, part 4. Now see, this is again a current context question. In 2020, there was COVID, and the next year they asked. Yeah, end of last year is bank rate. What are the key features of the monetary policy adopted by the central bank to address financial distress of households and enterprises during the COVID-19? So that's a current context question, Lamai. That is not something that they will ask you now. So during COVID-19, what did the central bank do in terms of monetary policy? That question I will skip now because you can refer to the answer that is not relevant anymore. Okay. Good for you all to know though. Okay. Then 2022. 22, question number 6, part 4. Mention the different techniques available to the central bank for controlling money supply. This is one of the most disappointing questions ever. Okay. So it's a 7-mark question. And this is the economic crisis here. They could have asked a very interesting question, but what they said is mention the different techniques available for what? Mention the different techniques available to control money supply. So what are the different techniques? You can talk about all the tools, standing deposit facility rate, standing lending facility rate, open market operations, statutory reserve requirement. You can even talk about qualitative. You can talk about qualitative moral suasion. You can talk about imposing credit limits, bank rate, repo, reverse repo. So any 7, if you mention, you can get. What current context that you can get, we have discussed enough and more in all our classes. You can refer to those. Okay, that's 2022, part 4. You can say policy rate. You just don't say that the policy rate is SDFR, SLFR. So right now, if you say policy rate, that means it's the overnight policy rate. Policy rate is still there. It's just that the policy rate is no longer SDFR, SLFR. Now the policy rate is the overnight policy rate. Yeah. So when you say mention, now it's a 7-mark question also. No? Even just stating this is enough. But you think Harina again. So 7-mark question can 1.5 minutes per mark. You can take roughly around 10 to 11 minutes to do this. So what I will recommend is write 1 line about it. 1 line about it you can give. No, treasury bills, treasury bonds is not an answer. That's not this thing. Open market operations is. So buying and selling that treasury bill, treasury bond is the tool. Treasury bill, treasury bond won't be the answer. So as long as you're given qualitative and quantitative stuff, 7 of it, you will get your answer. It's like a free mark ever. So sometimes now we don't get scared when they sometimes give you big questions. Sometimes big questions are the easiest questions there. It's a 7-mark question just to mention 7. What you do is now write a 1 line about it. Write about, okay, what is SDFR, what is SLFR, not 1 line clear. But here, since they say mention, even just stating it is enough. But just to make it more complete, write 1 line about it. Okay, done. Then 2023. Again, a very easy one. Describe 3 major tools could the central bank use in pursuing a contractionary monetary policy. So can you tell me, Lamai, 3 things they can do to have a contractionary monetary policy? We'll try to combine 3 main things together. What can they do with their policy rates? Now, at that point, it was SDFR, SLFR. Now it is overnight policy rate. What can they do? Increase or decrease? Policy rates, they can increase. Right? So increase that. So right now, they have to increase the overnight policy rate. Or earlier, they would have increased the standing. Now, right now, if you increase the OPR, SDFR, SLFR automatically will go up, right? So that'll happen. So then explain that for 2 marks now. And then explain how does that lead to a contractionary monetary policy? How does that lead to contracting money supply? Okay, that is 2 marks. After that, in terms of open market operations, what can they do, Lamai? Buy government securities or sell government securities? They can sell government securities. So then remember for MCQs, we learned that story. And explain. That's how they can contract. Okay. Another one. What can they do with the SRR? Statutory reserve ratio. They can increase the SR. I would feel these are the three main things that you can talk about. Apart from this, you can talk about a few other stuff as well, but bank rate and all won't be main one time. They're talking about, see, describe three major tools. No, so I will definitely write policy rates and open market. The next one I would give it as SRR. Don't write things like bank rate and bank rate are very indicative or a number to the rate saver. It doesn't make a big thing. Okay. Then that is also easy. So outline, yes, give a small 1 to 2 line explanation. OPR increases, yes, that will happen now. Then the latest paper, 2024. 924, they had two questions. One is, what would be the impact of an increase in the SRR on the money supply and the banking system's ability to create money? Easy one, Elamai. So if you increase the SRR, what will happen? Remember, there are enough and more MCQs. So now you have to explain anything. If the SRR increases, what happens? Now commercial banks have to keep a lot of reserves in the central bank. And they have to keep a lot of required reserves. So that means the amount of money they can give out as loans to the public will come down. That's why they're saying reduction in lending capacity. They can't lend now. And as a result, what can happen now? Now credit creation will go down, right? Lending capacity goes down. Now there will not be a lot of credit creation that can reduce your money supply. Then you can even talk about how is the deposit multiplier calculated 1 over SRR. If your SRR increases under, your multiplier comes down, meaning if there is what deposits coming in, it will not expand a lot. So overall money supply will, the same story that we had in the MCQ, you have to expand and write now. You have to expand and talk about how does the increase in SRR affect money supply and affect a bank's ability to create money. Create money, yani your credit creation story. So we talked about the money supply story, but the new part here is credit creation. So you talk about the deposit multiplier and all of that. Simple question, not hard. Again, you have to talk. Yeah, contracting money supply, correct. So this is exactly the answer from the marking scheme, Lamai. So I have broke down and given. Okay. Then the last question, same story again. The third time they're repeating this. Explain the concept of the interest rate corridor and analyze its role in monetary policy in Sri Lanka. So I gave the exact same answer in the marking scheme. So how the interest rate corridor, we have talked about it, how the interest rate corridor, how it influences your short-term interest rates, how it influences that average weighted call money rate, and by controlling the average weighted call money rate, how you can control all the other interest rates. Then you need to talk about how that can help long-term controlling inflation, how that can talk about liquidity management. Remember, if the average weighted call money rate is increasing, that's an indication that there is a shortage of liquidity. Then you have to inject liquidity, right? If there is, it's coming down, that means there is so much of money. So all of that things that we have talked about, right? I just put that. So now what you will see, Lamai, in the marking schemes, now the marking schemes, Lamai, are given as with headings and points. This is indication, Lamai, they are using AI for making these marking schemes also. So usually this type of format, right, where they give a main point and a heading. I sometimes refine my answers also with ChatGPT and all of it. It's the same format that they're giving there. So that is OPR can be a question in your year. We have discussed that in detail. So same story. We have done this question before, how the interest rate corridor helps with this. So see, now there are some general questions, right? For these general questions, once you have wrote answers, right? You've written answers once or twice, then you get the hang of it. Then you can handle that question very well. Okay, so that's all with monetary policy. I would say my monetary policy is one of the most difficult parts in your entire syllabus. But if you are handling monetary policy pretty well, you can handle the other parts also quite easily. That's why we did monetary policy in our special seminar series, because it was a difficult area. So even if it's a little difficult for you, then don't worry, that is natural. But if you're handling this difficult area pretty well, trust me, you've got it covered really well. So that's it that I wanted to do. The next part of, so listen carefully, the next part of money and banking is focus area 25. that is credit creation. That part we have done before. Around 2 months ago, I did credit creation. I just skipped the others and did that. So that recording also, was it there on YouTube? Can't remember. If it's not there, I'll try my level best to upload it as soon as possible. I think it's there. I'll try my level best to upload it and send it across. So then with this, unit number 7 is done, Lamai. On Friday, now this Friday, the entire day, we will do unit 8. So this Friday, we have mainly 2 sessions. Friday morning is where we will do focus area 26. That is about the externalities, government failure, market failure, that part. And then we have focus area 27 and 28. 27 is about government revenue and expenditure. 28 is about government debt, budgets, financing the budget, and all of that. So these 2 parts are small. 27 and 28 are comparatively small. That's why I'm doing that at night. 26 is a bit long, so I'm doing that in the morning. So Friday, we'll have a session from around 8 to 11. That's the morning session. We'll finish this. Night is our regular class now. So then in the regular class, we will finish this and this. Okay. So Friday, we will finish unit 8. Saturday, we will finish unit 9. Sunday, we will finish unit 10. So 1 day a unit. That's why I told you this week, Lamai, allocate it mainly for econ. Get the econ work done. And within then the next 7-8 days, you will be completely done with all the past papers of econ. At least that is a big of a relief that you are completely done with all the past papers. And then on my end, I'll try my level best to find some time and put it onto YouTube also. Okay. So I will see you all again. Mock exam people, I will see you all tonight. The others, I will see you all on Friday for our unit 8 class. See you. Bye-bye.